All right, Econ 1A students. Today I'm going to record a video here that tries to tie together the material that we've been talking about so far. So talking about the Federal Reserve tools. Remember, the Federal Reserve is the central bank of the United States, which is responsible for regulating the money supply, setting monetary policy, and regulating banks. We're going to connect that to our model of money demand and money supply, and another way of looking at how money supply affects the macroeconomy. So we're going to do a couple of things here to kind of tie everything together, do a review of the most important parts of this chapter, of the last couple of chapters we've looked at. So you want to remember that, A, the Federal Reserve is the central bank of the United States. They do a lot of things. They collect data, they process checks, they pull old currency out of the market. So, for example, my son thought it would be really funny to take this $1 bill and tear it in half. That's going to the bank, and then the bank will send it to the Federal Reserve, who will pull it out and issue a new $1 bill. The other thing the Fed does is the Federal Reserve sets monetary policy. And monetary policy is just their policy tools that are designed to manipulate the money supply to help stabilize the economy. So the Fed policy tools that we've talked about so far are the reserve requirement, that kind of shows up, yeah. Open market operations, and the discount rate. And remember, reserve requirement is the required proportion of every deposited dollar in a bank that has to be held in reserve, and that's set by the Federal Reserve. Banks can hold excess reserves, but they can't hold less than the required reserve ratio. And the more banks hold in reserve, the fewer loans they make, the less they hold in reserve. The more loans they can make, the more that money multiplies through the economy, and the larger our money supply is. Remember, the money multiplier is the inverse of that reserve ratio. Open market operations is buying and selling bonds. If the Federal Reserve buys bonds from banks, that's going to change bank assets from being bonds, which they can't loan out, to being cash, which they can loan out, and that will increase the money supply. And then the discount rate is the interest rate that the Federal Reserve charges banks in order to, if the banks want to make a loan. And so if the discount rate is low, it's easier for banks to borrow money from the Fed, and that's going to increase their money supply, increase their supply of money, and allow them to make more loans, which will increase the money supply in general. And all of those tools, those three tools, are designed to affect the federal funds rate. Let's see if I get a good one on the first try. So the federal funds rate is going to operate like a lot of the other markets we've looked at so far, where the cost of money is going to be the interest rate or the federal funds rate associated with that. So the market for federal funds is going to be a lot like every other market we've seen before. We're going to have the federal funds rate be the interest rate that the Federal Reserve is targeting. And what we're going to see is that the Federal Reserve is going to try to target a specific level of a federal funds rate with the hopes of having that influence other interest rates. And so we're going to have a downward sloping demand curve and upward sloping supply curve for this market for federal funds. And what we'll see is basically if there's some equilibrium quantity of federal funds, let's say that's an F1, and some current interest rate associated with those federal funds. In the book, it starts out in equilibrium at like 1.5%. I think the current federal funds rate is pretty low, in the neighborhood of 1%. target or lower. And so if the Federal Reserve decides, hey, right now the economy is not in a good position, maybe what we want to do is increase the supply of money to try and lower the federal funds rate, because that will signal to the market to lower other interest rates to make it easier for businesses to get access to loans and households to get access to loans to try and grow the economy. So right now we're going through a time when that's something the Fed might do. They might want to target a lower federal funds rate. And so they're going to use one of their three tools to do that. If they want to use reserve requirements, what they'll do is lower that required reserve ratio. So if we decrease the required reserve ratio, that's going to have the effect of increasing the supply of money, and that's going to have the effect of lowering interest rates. And so the way that would work is, sorry, that pen's a little funky. We would see that have the effect of shifting the supply of federal funds out to some new level, increasing the quantity of federal funds available, and lowering the interest rate to maybe 0.75%, to try and make it easier for small businesses to get loans to try and stay in business, or make it easier for people to get loans to buy new cars or things like that, to try and stimulate the economy, right? So get more money out there, lower the cost of borrowing money, stimulate the economy. One way to do that is with the required reserve ratio. Let's say we're in the opposite case, and instead of trying to lower interest rates, we want to shrink the economy. So maybe we're worried about inflation, or we're worried that we've had a lot of growth and we want to kind of slow the growth down because we're afraid our economy is churning too hard, too fast, and it's something that happens. We saw that happen in the 70s and 80s with Volcker disinflation. Come on back there. All right. So then what we could do is we could use one of our same Fed policy tools to try and shrink the money supply, raise interest rates, slow the economy down because maybe it's burning too fast, too hot, and we want to control it. So we could do something like, we could use the discount rate. The discount rate is that interest rate that we charge, that the Federal Reserve charges banks. So if we increase the discount rate, that's going to make it more expensive for banks to borrow reserve money from the Fed, which means they're going to be less able to make loans. That's going to have the effect of shifting the supply of money in, which is going to have the desired effect of increasing the federal funds rate and increasing interest rates. So that would look like this. We'd see the supply of federal funds shift in, the equilibrium interest rate go up to maybe now it's 1.5%, borrowing money got a little bit more expensive, and the quantity of federal funds available shrinks. Cool? I feel like the reserve ratio we spend a lot of time talking about. The discount rate is pretty intuitive. If you want to raise interest rates, you raise the discount rate. If you want to lower it, you lower it. Open market operations, I think, is a little bit of the more confusing one. So let's go over that one, and we'll look at both examples. So let's start over with a new clean graph. If we have our market for federal funds, with some quantity of federal funds here, and the federal funds rate up here, equilibrium demand, equilibrium supply, and some quantity. Let's put our equilibrium interest rate at 2%. The first thing we want to do is we want to shrink the economy. Let's start out with that. If the Federal Reserve wants to raise interest rates, contract the economy, make the economy slow down, raising interest rates does that, right? It makes it less easy to get a loan, less easy to invest, less easy for business to expand. So if they want to increase the interest rate, they have to shrink the money supply, which means they have to reduce the amount of cash reserves banks have. And so what they'll do with open market operations is they will sell bonds to banks. Selling bonds to banks means banks are going to have more bonds and less cash as reserves. Yeah. So that's going to decrease the amount of cash reserves, which is going to have the effect of shifting the money supply in, raising the federal funds rate, and raising interest rates. So that would look like this. They're going to sell bonds, which means banks are going to buy those bonds and give the Federal Reserve their liquid cash, right, their dollar bills. That's going to shrink the supply, shift the quantity of federal funds in, and raise that target interest rate. Maybe now it's up to 2.5%. On the other hand, if we're in a period of economic crisis, like there's a global pandemic and everyone's freaking out, and small businesses are worried they aren't going to stay in business, and we want to try and support small businesses and support the economy, what the Fed can do is the exact opposite. We use those open market operations to, instead of trying to shrink the economy, grow the economy. So in that case, what we would do is we'd see the Fed buy bonds. Take those bonds that are not loanable out of bank reserves and give them cash. Because that's what happens when you buy something, right? You're trading cash for something that's not cash. So if they buy bonds, that means banks will hold more cash reserves. Which means they can make more loans, which means the money supply is going to shift out, which means we're going to see interest rates go down. And in the federal funds market, it would just look like this. Supply curve shifts out, equilibrium quantity of federal funds shifts out, and the equilibrium interest rate decreases to, say, 1%. It's cheaper to borrow money, easier to borrow money. There's more money available, and so that helps to push the economy forward. So those are the Federal Reserve tools, our central bank tools to create monetary policy to try to stabilize the economy. The next thing we did was we talked about money, and we wanted to talk about money in terms of the money supply. The first part of that was we talked a lot about this idea that money is neutral, monetary neutrality. So we said that if you increase the money supply, you're not going to affect the any real variables. You're not going to affect real GDP. You're not going to affect real prices, real GDP or real interest rates. You're just going to affect inflation. And we derived that two ways. The first way was we took and we looked at the value of money relative to the price level. So we had the price level, P, and the value of money, the value of a dollar, 1 divided by P. And so if the price level is, say, $100, then the value of $100 is 1 over 100. So if we're talking about being able to buy, say, I can buy a week's groceries for one person with $100. That means that $1 buys 1/100th of my basket of week's groceries. And as the price level goes up to, say, $200, now $1 only buys 1/200th of that same basket of groceries, right? And we can put in here maybe $50 and 1/50th. Something like that. Then we said, that's super clear, that the money supply is set by the Fed, and that there's going to be a inverse relationship between money demand and the price level. So basically, between money demand and the value of money. So as the price level goes up, we're going to demand more money because it's going to take more money to buy stuff. So as the value of money goes down, each dollar buys less and we have to demand more money, right? So if $100 buys my basket of goods, then all I need is $100 to do that shopping trip. But if the price level keeps going up, then I'm going to need to demand more money. So our money demand curve is going to be inverse to the value of money and positively related to the price level. And all that is, we use that to prove money neutrality. And it gets us a little bit more familiar with money supply. The other thing we want to think of is we want to think about money demand and money supply, and that's going to come in with the next sort of set of information we talk about. But it's going to be the idea that money supply is neutral or is neutral to the changes in the price level. It's determined by the Federal Reserve. But another way we can think of it is sort of in the same way we talked about the market for loanable funds. So if you remember, we talked about the market for loanable funds. That's not helping. Where we have the interest rate up here and the quantity of loanable funds down here. We're going to use something really similar to that, where we had our demand for loanable funds was equal to investment, and our supply of loanable funds was equal to national savings. National savings, remember? And we talked about the quantity of loanable funds and the equilibrium interest rate. That was in our closed economy, where we talked about public savings and private savings and that kind of stuff. So we're going to get back to that. And that's why we were talking about the open economy version of it, where we would add back in imports and exports. But if we add back in imports and exports, we have to also add in the fact that those imports and exports have money associated with them, and that's net capital outflows. So all those things are going to come together in the next couple of models. So hopefully that gives you a little bit of a sense of where we've been, where we're going. I'm going to put together another video for you guys about what's the most important stuff from the next couple of chapters, and we'll keep moving on. Let me know if you have any questions about the Federal Reserve tools. Let me know what questions you have about monetary neutrality and inflation. Remember, inflation doesn't have very big costs to us unless it's very, very high. So there's those small costs, things like menu costs, shoe leather costs, the redistributive effects, and the uncertainty costs. But all of those are relatively low so long as inflation stays relatively low. And we're talking about like 2 to 3% being relatively low. So let me know what questions you have about this stuff, and I'll put together another video for you guys in just a little bit. All right. Thank you. Stay safe.